First of all, let's start off with, of course, you're going to be a big fan of it because you are the chief economic advisor, but tell me what, in the government's view, does this bring for the people?
Well, you don't have to take my word for it. There are commentators and also business people, and all of them have said that this is a responsible growth-oriented budget, and we wouldn't call it a pre-election budget.
All right, so the government increasing capex by a third. The private sector investments are still weak. But when do you expect private investments to start coming in and helping you guys also get to your deliverables?
The private sector investment isn't particularly weak. If you look at the data of private corporate sector, listed companies, and go through their earnings reports, which is what one of the financial institutions has done. And we see that in the last 3 financial years, including the current financial year, in the first half, the private corporate sector capex has actually been rising from 2.1 trillion rupees to 2.4 to 3.3 trillion rupees. So clearly, in the last several years, we have been buffeted by multiple global shocks. But through that, as the corporate sector's balance sheet has strengthened and profitability has improved, partly because of the government's tax cuts in September 2019, etc., the private corporate sector is indeed beginning to invest, and it is backed up by numbers.
Van, good to see you again. It's been called a pro-growth budget. And growth is seen between 6 and 6.8%. I'm just wondering, under what circumstances, Van, will India achieve 6.8% growth?
Well, honestly, at the moment, I mentioned in the survey as well, I have chosen the range of 6 to 6.8, and with the baseline projection of 6.5%, which means I kind of point out that the downside risk is slightly higher than the upside to the 6.5% baseline real GDP growth estimate. What could take us to 6.8 if the global commodity prices decline meaningfully and stay there? And as the financial markets currently expect, if the Federal Reserve were to halt its rate hikes and even contemplate rate cuts, and the US dollar weakens and capital flows return without being volatile as they were in the current financial year in the first half, then together with the government's capex, private sector will also continue to increase its investments, and then we can look at the possibility of heading towards 6.8.
Of course, we've seen how India has a very high debt burden. Might that counter fundamentals in the country, impact growth in the end?
Absolutely, you are right. I mean, first of all, I would like to point out that between 2005 and 2021, in the last 15, 16 years, India, Indonesia, and Germany are one of the 3 countries, whose public debt to GDP ratio has barely widened. In 2005, India's general government debt to GDP ratio was 81%, now it's 84%, whereas several other countries, emerging and advanced, have seen their public debt expand by several percentage points in the 10s and 20s and so on. So in that sense, the public debt has remained stable. Obviously, in the last 2-3 years, it has gone up because of the pandemic shock and the need to respond to the pandemic-induced economic dislocation. 2 to 3 years of good nominal GDP growth of even around 10% per annum, and we have shown that in a box item in the economic survey, would lead to a meaningful reduction in the general government debt ratio.